You walk into the investing world and someone hands you a menu. Common stock, preferred stock, corporate bonds. Three completely different investment types, all from the same company, all available to buy. But what's the actual difference? Which one pays you more? Which one is safer? Which one is right for you? Most investors only know about regular stocks and miss out on two powerful income-generating alternatives. Today, we're breaking down all three so clearly you'll know exactly what each one is, how each one works, and most importantly, how to actually buy any of them. Let's get into it. By the end of this video, you'll understand exactly what common stock, preferred stock, and corporate bonds are, how they're different from each other in terms of risk, income, and ownership, and the exact steps to buy any of them through a brokerage account. These are three different ways to invest in the same company, and knowing when to use each one can significantly improve both your income and your investment strategy. Let's start with the basics. Quick disclaimer before we dive in. Everything I share on this channel is purely educational based on my 10+ years of personal investing experience in stocks and crypto. I am not a licensed financial advisor, and this is not financial advice. The examples I use are for educational illustration only and are not investment recommendations. All investing involves risk, including potential loss of principal. Please do your own research and consult qualified financial professionals. Now, let's understand these three investment types. Before we compare the three types, let's understand why companies offer all three. Companies need money to grow, build factories, hire workers, expand globally. They have three main ways to raise this capital from investors. First, they issue common stock, selling pieces of ownership to the public. Second, they issue preferred stock, a hybrid that offers priority income to investors. Third, they issue corporate bonds, essentially borrowing money from investors and promising to repay it with interest over a fixed period. As an investor, you can choose which of these three instruments fits your goals. Want ownership and growth potential? Common stock. Want stable priority income? Preferred stock. Want predictable fixed income with the highest safety priority? Corporate bonds. Let's break each one down. Let's start with common stock, the one most investors already know. When you buy common stock, you're buying a piece of ownership in a company. You become a part owner of that business, no matter how small your holding. As a common stockholder, you have two ways to make money. Capital gains, meaning if the stock price rises from $150 to $200 and you sell, you pocket the $50 difference. And dividends, if the company chooses to pay them. Common stockholders also get voting rights, typically one vote per share, allowing you to vote on major company decisions like electing board members. But here's the critical trade-off. Common stockholders are last in line when it comes to getting paid. If the company goes bankrupt, bondholders get paid first, then preferred stockholders, and only whatever is left, if anything, goes to common stockholders. In a bankruptcy, common stockholders usually get nothing. Common stock offers the highest potential upside through price appreciation and growth, but it also comes with the highest risk and the lowest payment priority. Here's the most important visual in understanding all three investment types: the payment priority ladder. Think of it like a line of people waiting to get paid when a company distributes money, whether through dividends, profits, or in a worst-case bankruptcy scenario. At the very top of the ladder are secured creditors, like banks that hold physical assets as collateral. They always get paid first. On the third rung are corporate bondholders. They get paid before any stockholders. On the second rung are preferred stockholders. They get paid before common stockholders. And at the very bottom are common stockholders, the last to receive anything. This ladder works in reverse for potential reward. Common stockholders at the bottom have the most to gain when the company thrives because their claim on profits is unlimited upside. Bondholders at the top have capped fixed returns. This risk-reward trade-off is the fundamental principle connecting all three investment types. Now let's talk about preferred stock, the investment type most investors don't even know exists, but that can be extremely powerful for income-focused portfolios. Preferred stock sits right in the middle between common stock and corporate bonds. It's a hybrid. From the stock side, it trades on a stock exchange and has no maturity date. You can hold it indefinitely. From the bond side, it pays a fixed dividend rate.
usually a percentage of its par value, and preferred stockholders get paid before common stockholders. Here's what makes it particularly attractive for income investors. Preferred stock typically has a par value of $25 per share and pays a fixed rate, let's say 6% annually. That's $1.50 a year per share, paid quarterly. Unlike common stock dividends, which can be raised or cut by management's discretion, preferred dividends are fixed. You know exactly what you'll receive. The trade-off? No voting rights and limited upside. If the company's stock doubles, your preferred stock barely moves because it's valued for its fixed income, not its growth.
Not all preferred stocks are created equal. There are three important types you need to know before buying. First, cumulative preferred stock. This is the most investor-friendly type. If the company misses a dividend payment for any reason, that missed payment doesn't disappear. It accumulates and must be paid in full to preferred shareholders before the company can pay a single cent to common stockholders. This is significant protection for income investors. Second, non-cumulative preferred stock. If a dividend is skipped, that payment is gone forever. You simply don't receive it and there's no catch-up obligation. This is less common, but does exist. Third, convertible preferred stock. These shares can be converted into a predetermined number of common shares at your discretion. This gives you fixed income safety now, plus the option to convert and participate in growth upside if the common stock performs well. When researching any preferred stock, the first question to ask is cumulative or non-cumulative. That single answer tells you a great deal about how much protection your income has. Corporate bonds are fundamentally different from both types of stock. When you buy a corporate bond, you're not buying ownership in the company. You're lending the company your money. Think of yourself as the bank. The company needs capital, so they issue a bond, which is essentially a formal IOU. You give them $10,000 today. In return, they promise two things. First, to pay you regular interest payments, called coupon payments, at a fixed rate, let's say 6% annually or $300 every 6 months. Second, to return your full $10,000 on a specific maturity date, maybe 5 years from now. You know exactly what you're getting and when. That predictability is why bonds are considered safer than stocks. But remember, the company doesn't share profits with you beyond the fixed interest. If Apple has the most profitable quarter in history after you buy their bond, you still only get your 6%. The upside is capped, but the income is guaranteed, assuming the company doesn't default, which is why credit ratings matter so much with corporate bonds. With corporate bonds, the most important factor beyond the coupon rate is the credit rating. This is a grade assigned by major rating agencies like Standard & Poor's, Moody's, and Fitch that tells you how likely the company is to pay you back. AAA is the highest, safest rating. Companies like Apple and Microsoft have top-tier ratings. The default risk is extremely low, but the yield is also lower because investors don't need to be compensated for much risk. As you go down the scale, BBB is the lowest investment grade rating. Anything below BBB, often called high yield or junk bonds, pays higher interest but carries significantly more risk of the company defaulting, meaning they stop paying you interest and potentially can't return your principal. For beginners, stick to investment grade bonds rating BBB and above. The yield might be slightly lower, but your capital and income are far better protected. As you gain experience and understanding, you can selectively explore high yield bonds, but that requires much deeper research. Let's put all three side by side so the differences are clear as crystal. Common stock. You own a piece of the company. Dividends are not guaranteed, you're paid last in any distribution, you have voting rights, and your upside is unlimited, but your risk is highest. Preferred stock. It's a priority income share. The dividend is fixed and reliable. You're paid second after bondholders, but before common stockholders. You usually have no voting rights. Your upside is limited, but income is more dependable. Corporate bonds. You're a lender, not an owner. The interest payment is completely fixed and contractually obligated. You're paid first before any stockholders. You have no voting rights and no ownership. There's zero upside beyond your coupon rate, but your risk is lowest and your income is most predictable. The choice between these three isn't about which is best overall. It's about which is best for your specific investment goals. Growth and wealth building? Common stock. Reliable income with moderate safety? Preferred stock. Maximum income predictability and safety? Corporate bonds. Who is each investment type best suited for? Common stock is ideal for growth investors with a long time horizon, typically 10 years or more. If you're young, building wealth, and can handle the volatility of watching your portfolio rise and fall, common stock is your primary vehicle. The unlimited upside and ownership participation is worth the higher risk over long periods. Preferred stock is best for income investors in middle age who want reliable fixed payments without the volatility of common stock. Think someone building a dividend portfolio like we discussed in our last video, wanting steady quarterly income they can count on. Corporate bonds suit safety-focused investors who prioritize capital preservation and guaranteed income, typically those approaching or already in retirement. They need to know their income will arrive on schedule regardless of market conditions. Here's the important thing, though. Most serious investors use all three across different proportions, shifting gradually from more common stock in youth to more bonds and preferred stock as they approach retirement. The balance evolves with your life stage. Now let's cover how to actually buy all three, starting with common stock, which is the simplest to buy. Step 1. Open a brokerage account. Fidelity, Schwab, Vanguard, and TD Ameritrade are all excellent choices with zero commission trading on U.S. stocks. Step 2. Search the ticker symbol of the stock you want. Apple is AAPL. Microsoft is MSFT. Coca-Cola is KO. Step 3. Click the Buy button. You'll be asked to choose between a market order, which buys immediately at the current price, or a limit order, which only executes if the price reaches your specified level. For well-known liquid stocks, a market order is usually fine. For smaller or less liquid stocks, use a limit order to control your entry price. Step 4. Enter either the number of shares you want or the dollar amount you want to invest. Many brokerages now offer fractional shares, so you can invest any dollar amount. Step 5. Review the order details and confirm. Step 6. Shares appear in your portfolio immediately after confirmation. That's it. You own common stock. Buying preferred stocks through a brokerage works similarly to common stocks, but with some important differences. First, the ticker symbol format. Preferred stocks have unique tickers that include the series designation. For example, Public Storage Preferred Series B trades as PSA.PRB on some platforms, or PSA-PB on others. JP Morgan Preferred Series C is JPM.PRC. Before clicking Buy on any preferred stock, run through this essential checklist. 1. Is it cumulative or non-cumulative? We discussed why this matters enormously. 2. What is the fixed dividend rate? 3. What is the call date? Companies can call or buy back preferred stock at par value on or after the call date, which could end your income stream. 4. What is the par value? Usually $25. 6. Is it financially stable? 7. Is it convertible? For beginners, there's actually an easier path. Preferred stock ETFs like PFF from iShares or PGX from Invesco hold hundreds of different preferred stocks in one fund. You get automatic diversification across many preferred stocks without needing to research each individual one. This is often the best starting point. Buying corporate bonds is slightly different from buying stocks. There are two ways. The first is buying bonds directly. You'll need a brokerage with a fixed income or bond market section. Fidelity, Schwab, and TD Ameritrade all have robust bond trading platforms. You search using a bond screener, filter by issuer, maturity date, credit rating, and yield to maturity. Most corporate bonds come in $1,000 face value increments, so the minimum investment is typically $1,000. Bonds trade over the counter rather than on exchanges, which means the pricing can be less transparent than stocks. The second and usually better option for beginners is bond ETFs. LQD from iShares holds over 2,500 investment-grade corporate bonds in one fund with a yield around 4.5%. VCIT from Vanguard is another solid diversified corporate bond ETF. For higher yield with more risk, HYG focuses on high-yield corporate bonds. Bond ETFs trade exactly like stocks with no $1,000 minimum, instant diversification across hundreds of bonds, and much better liquidity. For most investors, especially beginners, bond ETFs are absolutely the right starting point. Here's how these three investment types work together across a lifetime portfolio.
In your growth phase, ages 25 to 35, a typical allocation might be 70% common stock for maximum growth, 20% preferred stock for some income stability, and 10% bonds for a small safety cushion. As you enter your balance phase, around 40 to 55, you might shift to 50% common stock, 30% preferred for growing income, and 20% bonds. By retirement, 60 plus, the balance often shifts to around 25% common stock for continued growth against inflation, 35% preferred stock for reliable income, and 40% bonds for capital preservation and guaranteed payments. The key insight? These aren't competing investments. They're complementary tools that serve different purposes in your overall financial plan. Savvy investors use all three in proportions that match their current life stage and goals.
Let's bring everything together. Common stock makes you an owner with unlimited upside and voting rights, but paid last and with no guaranteed income. Buy it through any brokerage by searching the ticker symbol. Best for growth investors with long time horizons. Preferred stock gives you fixed, reliable income and priority over common stockholders, but with limited upside and usually no voting rights. Always check if it's cumulative before buying. Buy individual preferred stocks by their unique ticker or use ETFs like PFF for easier diversification. Best for income-focused investors. Corporate bonds make you the lender, not the owner. You're paid first with fixed contractual interest and your principal returned at maturity, but no ownership upside whatsoever. Buy through a brokerage fixed income section or use bond ETFs like LQD for beginners. Best for safety-focused and retirement age investors. 3 different tools, all from the same company, all serving different investor needs at different life stages. The most sophisticated investors don't pick one and ignore the others. They use all 3 in proportions that evolve as their goals, income needs, and life stage change. If this video finally cleared up the confusion between common stock, preferred stock, and corporate bonds, please hit that subscribe button and turn on notifications. Every week on the Investing Whiteboard, I break down investing concepts this simply using real experience from over a decade in the markets. Drop a comment below and tell me which of these 3 investment types are you most interested in exploring. Common stock for growth, preferred stock for income, or corporate bonds for safety. I read every single comment, and I love seeing where you are on your investing journey. Thanks for watching. Remember, the best investors don't just buy stocks. They understand the entire capital structure of the companies they invest in. See you in the next one.